market. If your stock portfolio goes down, then maybe your bond portfolio will gain to offset that loss. The same holds true for real estate. The value of housing doesn't move in lockstep with stocks or bonds, and that makes it attractive. Some of us, though, have more than enough of our wealth invested in real estate already. If you own your home, then you have a big chunk of money in real estate right there, and it doesn't matter if you have a mortgage. Your $200,000 home declining 10% means you've dropped $20,000. I don't have to tell those of you in San Francisco or New York City about the amount of money you need to tie up in a house. A 10% drop in an average home in a place like that can wipe out a year's pay for some people. No, most of us don't need to invest in real estate beyond our own house. We already have plenty. You can find tools to help you with your asset allocation decision on the web. Search for Asset Allocation Calculator or Portfolio Allocation Tools or something along those lines. Most of them will ask you for your age, how much you have to invest, and for some measure of your risk tolerance. Some will ask for your tax rate and how much you plan to save each year. Always use a little common sense when visiting a new website, of course. There's no reason for your Social Security number to affect your allocation, is there? If a site asks for that, then I'd go somewhere else. I'll bet you'll be surprised at how much of your wealth these tools suggest that you invest in stocks. I experimented with a couple of these allocation tools, and the recommended allocation to stocks averaged about 50%. I wasn't holding anywhere near that much in stocks. Guess what? I'm still not. I didn't run out and change my allocation. I know that I'd rather sleep well than eat well. I'm not going to change my asset allocation because of what a black box on the web says I should do. And you shouldn't either. You should still play around with a couple of asset allocators to get a feel for the factors that they use to determine your suggested asset mix. You'll find that the younger you are, the richer you are, and the more you can handle risk, the larger proportion of stocks they recommend you hold. These rules of thumb make sense. For example, if your investments fail, but you're young, then you still have a long time to make up for it. You can get a second job, live a more frugal lifestyle, or even change careers. Those changes can make a big difference over a long time period, but not so much if you're near retirement. I've never seen an asset allocation tool that asks if you're planning to leave most of your assets to your heirs. We saw in Lecture 5 that planning to leave a bequest changes your investment horizon because you're investing for your heirs, not yourself. Your own age is mostly irrelevant in that case. Part of my goal in this course has been to help you become a better informed investor, but a more important part has been to build a framework so that you can look at investing decisions the right way. I hope I've kindled your interest so that you want to learn more. Yes, we've covered a lot of ground, but we've barely scratched the surface of the vast world of investing. One way to learn more about investing is to join an investment club. An investment club is a group of people who get together to share opinions about the stock market. Sometimes they actually make investments collectively too. I like the idea of investment clubs, but not for the reason most other people give. My friend Reggie is a retired postal worker and a great guy, but I don't think he can watch the news, read about Walmart, and then tell me whether I should buy or not. Sharon is a registered nurse who can zero in on people's feelings as well as anyone you'll ever meet, but I don't think she can possibly know more about Macy's than the guys who analyze Macy's for a living. No, I don't think that an investment group can pick winners for me. A group like that can still do a lot to help, though. They can share advice about choosing brokers, for example. They can help me discipline my investing. Think of Alcoholics Anonymous or a good weight management program. In a moment of weakness, these groups give you someone to call for support so that you don't take a step backward. Suppose I hear an analyst on TV say he thinks Macy's earnings might be bad this quarter, and I feel the irresistible